In about 18 months, Americans lost $17 trillion. Homes, jobs, retirements, gone. The 2008 financial crisis was the worst economic collapse since the Great Depression. But what if it had never happened? What if one chain of decisions had gone differently? The answer reshapes almost everything about the world you live in today. Let's run the alternate timeline. This matters more than a history lesson, because 2008 didn't just vanish. It rewired your life, your rent, your wages, your odds of owning a home, the entire decade that followed. To imagine a world where it never happened, you first have to understand exactly how much it actually took. And the numbers are staggering. Then we'll build the world that could have been and find the uncomfortable truth hiding inside it. Let's count the damage. From the 2007 peak to the 2009 bottom, U.S. household wealth fell by about $17 trillion in real terms, roughly a quarter of everything American families owned. In 2008 alone, net worth dropped $11 trillion, the largest single-year decline ever recorded. It came from two places. Stocks. The market lost about $7.4 trillion. Real estate. Another $3.4 trillion in home value evaporated. The combined hit averaged nearly $100,000 per U.S. household. Then the jobs. Unemployment doubled to 10% by October 2009. Around 8.7 million jobs disappeared. GDP shrank about 6%. Median family income fell roughly 8%. Millions lost their homes to foreclosure. This wasn't a dip. It was a demolition. Now the fun part. Imagine the crisis never lands. The housing bubble deflates gently instead of exploding. Lehman Brothers doesn't collapse. The dominoes never fall. In that world, that $17 trillion is never destroyed. Millions of families keep their homes. The retirements that got cut in half stay whole. The 8.7 million jobs are never lost. And the people who spent years climbing back out never fall in. But here's the twist most people miss. A lot of what we now take for granted was born from the wreckage. The 2008 crash created a once-in-a-generation buying opportunity. Stocks and homes went on sale, and the people who bought at the bottom built enormous wealth in the decade after. It forced sweeping financial regulation, and the near-zero interest rates that followed fueled the longest bull market in history. Erase the crash, and you might also erase the recovery that made a lot of fortunes. The alternate timeline is richer for some and poorer for others. So why did it happen at all? Because the system was quietly stacked to fail. Banks handed out mortgages to people who couldn't repay them. Those risky loans got bundled, relabeled as safe, and sold around the world. Everyone assumed home prices could only go up. When they didn't, the whole tower came down at once. The deeper lesson: financial crises aren't freak accidents. They're built slowly, during the good times, out of greed and the belief that this time is different. It never is. The seeds of the next crash are almost always planted while everyone feels safest. And this is the part that should get your attention. Crashes are not rare. Major market downturns have hit roughly once a decade for the last century. The dot-com crash. 2008, the COVID crash. Different triggers, same pattern. If you're investing for the long run, you won't avoid crashes. You'll live through several of them. That reframes everything. The question was never, will another crash come? It's, will you be ready when it does? The people wiped out in 2008 weren't unlucky. Most were just unprepared and over-leveraged at the worst possible moment. Here's the part of the 2008 story that gets buried under all the disaster headlines. It didn't make everyone poorer. It quietly made some people staggeringly rich. And looking at who and how is the real lesson. While most people were panic selling at the bottom, a small group did the opposite. Investors who kept buying through the crash bought the entire stock market at a roughly 50% discount. The S&P 500 bottomed in March 2009 and then began one of the longest bull runs in history, more than quadrupling in the decade that followed. Every dollar invested at the bottom became 4 or 5. The crash didn't destroy that wealth. It transferred it from the fearful to the patient. The same thing happened in real estate. Investors who bought foreclosed homes in 2009 and 2010 for pennies on the dollar rode the recovery to enormous gains and collected rent the whole way. Some of the biggest fortunes of the 2010s were seated in the rubble of 2008. So when we run the "what if it never happened" timeline, here's the uncomfortable truth. A world without the crash is a world without that once-in-a-generation fire sale. Millions keep their homes and jobs, a genuine good. But the greatest wealth-building opportunity most people will ever see in their lifetime also never appears. Every crisis really is split screen. Catastrophe for the unprepared, opportunity for the ready. And this is exactly why the people who study 2008 don't fear the next crash the way everyone else does. They've internalized the pattern. Maximum fear equals maximum opportunity. The crowd sees a burning building. The prepared investor sees everything inside it marked 50% off. That mindset shift, from crashes or disasters to crashes or sales for people with cash and nerve, is the single most valuable thing you can take from 2008. So how do you actually crash-proof yourself? 3 moves. Move 1. Keep an emergency fund. 3 to 6 months of expenses in cash. In a downturn, the people who don't have to sell or panic are the ones who come out ahead. Cash is what lets you hold. Move 2. Don't over-leverage. 2008 destroyed the people who borrowed to the hilt. Debt turns a downturn into a wipeout. Keep your borrowing sane so a bad year can't end you. Move 3. See crashes as sales, not disasters. Every crash in history was also the best buying opportunity of its decade. If you keep investing steadily when everything's red, you're buying the future cheap. The discomfort is the price of the discount. You can't stop the next crash, but you can decide whether it breaks you or builds you. So let's bring it home. 2008 erased about $17 trillion, doubled unemployment, and cost nearly $100,000 per household. A world without it keeps those fortunes intact, but might also erase the historic recovery that followed. Crashes come roughly once a decade, so the real move isn't avoiding them. It's being ready. Emergency fund, low leverage, and the nerve to buy when everyone else is selling. Now I want to hear from you. Do you think a world without the 2008 crash would be better off or worse? Make your case in the comments. I read every one. If this made you see crashes differently, hit like, subscribe for a new What If breakdown every week, and share it with someone who's nervous about the next one. I'll see you in the next one.